Right. Good afternoon, everyone. I'm trying to find my picture here. Welcome to Trading Foundation 301, week 3, day 4. This is a really important one. The use of volume in conjunction with open interest and delta, I think is probably missed by a lot of traders. And we're going to be talking about a couple of secrets here. Good morning, gentlemen. How are we?
Hey, Hogue, how are you?
I won't speak for everyone. I'm doing just fine. I tipped my light over, so if I'm a little dark, I'm not cowering in my depression cave. I just need to get a new light. As for today, we're also joined by Eddie Horn's going to help us out answering your questions. Eddie is great about as well any questions. He's a trading background, but also any questions about the program. He's your man. So Eddie, thanks for joining us.
Thanks for having me. I'm excited. I'm stoked. Looking forward to this. Thanks.
Thanks
All right.
for being with us, Eddie. Thanks again for all of you being with us. I'm sure that JD is doing well today. He's also known as the Dancing Bear, and we've got equities driving to the downside, at least for now. So hopefully everybody's having a good trading day.
Just so you know, Hogue actually gave me that nickname, the Dancing Bear, on my first day at Topstep. So,
well, you got lots of nicknames, JD, the Dancing Bear, and probably some we don't know about.
Cool.
All right. I don't know what happened to I don't see everybody. All right. Well, again, happy to have Eddie, JD, Holden. Good to see you as well. And Jack with us today. Let's jump in. Let's start taking a look at this. As usual, introducing myself, my name is John Hoagland, the Senior Performance Coach here at Topstep. 39 years in February of futures industry experience. Not all of them actually actively trading, more like 30 years of that. I traded on the floor of the Mercantile Exchange and other exchanges for 20 years. I'm from a long background of traders. Dad was a trader on the floor of the Board of Trade for 40 years. In 2009, opportunities were kind of going by the wayside in the pit, stepped out of the pit, started to learn to trade on screen. Joined Topstep with Eddie and Michael here in 2011, and it's been my pleasure to talk to, work with, and hopefully help the performance of traders from all around the world. Is what I'd like to do, and what I truly enjoy. So we're going to jump in here. And for those of you that are not familiar with the volume, of course, everybody's well aware of volume. I'm sure even some of your newer traders know what volume is. Value, open interest, right? So technicians could use a three-dimensional, if not more dimensional approach to futures market analysis. What is volume? Volume represents the total amount of trading activity or contracts that have changed hands in a given commodity or product for a single trading day. When we're looking at volume, we can use that to measure the pressure and intensity of price movement. Those of you that were with us for the auction process on Monday, volume is a big part of the auction process. The greater the volume, the more likely a price is going to continue in a particular direction. So again, volume, once again, measuring the pressure and intensity of price movement. Open interest is the total number of outstanding contracts that are held by market participants at the end of the day. I've had a lot of questions of people asking if you can monitor open interest in real time throughout the day. And the answer to that is really no. And you're going to see why in just a moment. There are platforms that claim to be able to judge or gauge open interest intraday, but I don't believe that they are going to be necessarily very accurate. It takes the exchange extra time the following day to come up with the actual real number. They give you an estimate early in the session for the previous day's open interest, It's not going to be finalized until sometime after 9 a.m. Central. So open interest, when you've got millions of contracts outstanding, it takes some time to come up with a real legitimate number. And something that probably going to be new for many of you is delta. The delta is it's a little different for those of you that come from an options past or history. Delta in futures is quite simply the number of contracts that trade on the offer. In other words, a market order lifting an offer is positive delta. The total number is that offer, which is positive, minus the number of contracts that trade on the bid. If you're using a market order to hit the bid, that is negative delta. So hopefully we're going to make this all come together for us today. And you can start watching delta on, I think just about every platform has a way to look at delta. Like some of them have cumulative delta, much like TS Trader or Trade-Of-8. They have cumulative delta. I believe Ninja Trader has cumulative delta. So there may be a little bit of math involved in gauging delta in the day time frame. I'm going to show you how to do that as well. Okay, don't forget, futures is a zero-sum game. For every long, there's a short. Every buyer, there's a seller. For every dollar made in a trading day, there's a dollar lost. There is no value creation in futures trading. The difference between, let's say, trading a stock, you buy a stock, you own a piece of a company. There's probably nobody directly betting against you. Sometimes some companies will be shorted. Mostly that's going to be from institutions. But as far as the general public, they're trading stocks from the long side. If you buy a stock, you're hoping that, number one, the earnings are going to be worth your while, and you're hoping that the value of that company increases. If you bought Apple when it first came out, you made a lot of money on value creation. That does not exist in the futures markets. So remember, every long, there is a short. Everyone you buy, somebody is betting against you. Everyone you sell, somebody is betting against you. So here's the math on open interest. And open interest, when you look at it over time, can help you determine the amount of money flowing into or out of a futures contract. So making an assumption that we're only trading one contract, if a new buyer, somebody that has no position, buys one from a new seller, also somebody that has no position, that creates a contract. Every contract has to have two parties and a beginning and an end. This is the beginning of a contract. One buyer, one seller meeting in the marketplace, creating a new position for both, creates that contract. That's going to be +1 in open interest. Now, one long old buyer and one old short or an old seller, somebody who's already holding that long position, meets somebody who's holding the opposite or the opposite. If they trade in the marketplace, they're going to remove one contract in open interest. Excuse me, I apologize. One new buyer and one old buyer. Okay, so I'm long, I sell it to somebody who is now beginning a new long position. That's not going to change open interest. There's a lot of contracts that get traded this way where there's no change in open interest, just the transfer of risk. We've talked about the markets are, in essence, the ability for producers and users to transfer the risk of price movement onto other traders, basically the speculators. So if we're going to be part of this industry, part of this this game of trading, it's really important to understand, I think, how open interest works. Now, you can get open interest in futures contracts, you can get open interest in options contracts. You do not see open interest in stocks. That would be shares outstanding. And you don't see open interest in Forex products as well, because a lot of those trades are taken by a central body that takes both sides, and so there is no direct risk transfer between let's say retail participants. I hope that makes sense. So when we're thinking about open interest, it changes every day. There's periods of time when the open interest is increasing. That's telling us that new money is moving into that product. When open interest is falling, money is leaving that product. And of course, there's times where over a period of days and weeks where the open interest will just kind of waffle up one day, down one day, up one day, down one day. You're going to see that if you begin to be paying attention and keeping track of volume of open interest. You're going to see that in markets that maybe have a tendency to remain range bound. There's also situations where you're going to see open interest dropping or increasing over a period of time while the market is range bound. Those are going to be some pretty powerful moves when we move away from them. I have an example for you as we get to that. All right. So what can be assumed about a market by monitoring open interest? And why should this be important to a short time frame trader? Again, the open interest is telling you the amount of contracts that are being created. When open interest is increasing, it's telling you there is more interest in that market. There's more money coming into that market. If it's directional, you're going to see how you're going to be able to use that to your advantage. You're going to be able to tell when there's less interest in a product by falling open interest. And in directional markets, combining volume and open interest and sometimes delta can give you really good hints as to potential changes in market state and sometimes even market direction. This is a longer term view of the performance of the market. We all see, the crude oil is currently trying to push higher and higher and higher. Some of the things that we look at to determine its success or failure in that is volume increasing? Is open interest increasing? And are there hints in delta of longer time frame participants continuing to put money in to that product, thus increasing open interest? It's not a complicated thing to kind of to think about. Once you have it, it's difficult to talk about in a clear way how important that this has been at times. There's times when monitoring open interest will seem like a waste of time, and that's okay. There's lots of times when a lot of different indicators aren't going to help you, but when volume and open interest and sometimes delta becomes really important, it becomes extremely important, and it can tip off changes again in the marketplace before they change. Who wouldn't want that? So when we're looking at markets, we're thinking, what direction is it attempting to go, if anywhere? And how good of a job is it doing getting there? Is it bringing in more participants? Is volume maintaining or increasing? Do we see the evidence of longer time frame traders in Delta? Okay. Take a screen share of this. This is mostly just based on volume and open interest. It's a little bit confusing when we get to the bottom of it, but we'll explain it so that everybody, I think, will understand. And I know there's a lot of smart people out there. Some of you may already know this. Some of you may be already looking at this. That's fine. When you get everybody tuned up into understanding volume and open interest and how changes in it can signal change in the bigger picture, which is really important even for day time frame traders. So when we're looking at this, we've got price, we have volume, we have open interest, and we have interpretation. Hang on, let me find a cooler way to do this. Okay. Price, volume, open interest, interpretation. What we're looking for is what direction price is going, what is volume and open interest doing, and what can be assumed or interpreted by that information. Okay. In an auction process, when there is a lot of volume, it's more likely to go in that direction or continue in that direction. So if we have price rising, we have volume rising and open interest rising, we have what I would say it looks like a very healthy upside auction. Volume is continuing to rise as price goes higher. Open interest continues to bring in new business, new participants, and creating new contracts as price continues to move higher, indicating money is still coming in the upside direction on those days. That's telling us that the market is really strong and that it's likely to continue in that direction. But as price continues to rise, okay, remember direction, performance, and volume starts to drop off. And some of those perhaps longs, while the market was moving up, have begun to sell off some of their product. That's an indication that this auction is tiring and that a potential change is in the wind. When we see this, we might start thinking, well, instead of just looking to buy weakness in this market that has a very healthy upside auction, we better start watching for opportunities in the opposite direction or both directions. Sometimes the market, as it's weakening, will tend to consolidate. It'll just hang there for a while. The auctioneer will be pandering at, looking for new participants to the marketplace. If he can't find new buyers on rising price, falling volume, falling open interest, there may be a change coming. It's the same way in the downside auction. As price continues to fall and volume continues to rise and open interest is rising, that's a healthy downside auction. The market is weak and likely to continue moving lower. Now, this is where it gets confusing. You would look at this as a strong downside auction versus the market is weak. Okay, the market is weakening as it gets near the highs. As the market starts to move lower, this is a healthy downside auction. I would call this strong downside auction instead of saying that the market is just weak. But again, as price continues to fall and volume starts to fall and open interest starts to fall, remember performance. What direction is the market attempting to go? It's attempting to continue to auction lower, but it's not bringing in new participants or volume. This market is changing. In other words, the downside auction is growing tired and weak. You may start to look for opportunities on both sides of the market or start looking for the opportunity to start to buy weakness in those markets. Okay. Take a screenshot of this. it's, really kind of simple. It's a little bit confusing as to the strength of the downside auction saying that the market is weak. The market is actually strong to the downside. As things start to change, the market may be changing also. All right. So a practical example. This was crude oil, the beginning of last year. Okay, now I collect volume and open interest and delta information. At the end of the year, I usually just kind of jettison it and start new. I wish I didn't do that. But what I can tell you is this is a daily chart. In this largely $2 range, in this period of time, watching open interest increased over 10% of the total open interest. There was an accumulation occurring in this area that was going to provide a very strong breakout opportunity, really in either direction. The breakout occurred to the upside. Now, we have all this open interest here that accumulated, again, about 10% of the total open interest. Total open interest in crude oil is generally right around 2 million contracts. In this period of time, we added over 200,000 in new open interest. This is a market that is building energy, and when that breakout comes, it's going to be substantial. We can see what happened on the several continuing moves to the upside. There was good volume. Open interest continued to increase. However, delta was negative. Now think about delta. Delta is going to be telling us who the more aggressive traders are. By aggressive traders, anybody who's using market orders. Most longer time frame traders are looking to make accumulations by buying the bid or selling the offer. It's not that they're risk averse that way. They're just trying to hide their activities. So as price continued to go higher, volume and open interest continued to go higher, our longer time frame traders just kept placing bids, letting us, the shorter time frame, weaker hands traders, try and pick the high. Is when they were able to buy some here, eventually the short time frame traders got wind of it, and they backed off. And sometimes you'll have the short time frame traders so short that by the end of the day, they're actually pushing price in the direction for the longer time frame. Recognizing with upside direction and increasingly negative delta, the presence of longer, stronger buyers is high. There's a higher probability of it. I've got something to show you here. This is basically April 9th, 2011. 2021. Look at the prices. We're not too far from that now. But when you see a delta divergence, price is going to be moving higher. This is the continuing delta, okay, continuous delta. So it's going to be telling you where delta is in a longer time frame. What we have to do is we have to pick the spot that the day starts. Here, negative 71,500. How is it negative 71,500? Obviously, we've had more aggressive sellers than we've had buyers. Delta negative is trades that are occurring on the bid. When you think about trading on the bid and a lot of market orders hitting the market on the bid, you would think that that would bring price lower, right? Normally that would be true. More aggressive selling moves price lower, unless there is somebody placing orders on the other direction that has, let's say, a lot deeper pockets than we do, longer time frame traders. You can see that price is actually moving higher over time while delta is increasing in negativity. The shorter time frame traders they're going to end up short against bigger, stronger participants. Here's the delta divergence on this day only. The market starts at negative 71,500 throughout the day. As price continued to move higher, delta continued to continue more negative. So at the end of the day, there's a 7,700 contract negative delta. What happened? Well, we had more aggressive sellers using market orders that were running into longer time frame buyers. Maybe they started buying here when they couldn't get any more bought here. They moved those bids up here. They spent some time accumulating longs up here. Then they don't get any more. They move those bids up here, and they scoop up as many as they can, again, from the short time frame traders. And then at the end of the day, the short time frame traders end up so short that they have to turn tail and go the other direction. And this is sometimes, if you've been watching the forecast, if you've been coming to a group coaching, the late spike sometimes is created this way. Okay, so the ability to recognize this is something that takes time and takes practice, if you will. Okay, now this is where I get my volume and open interest information. There's several different ways to get volume and open interest information. One of them is through a quote board, but that's only going to give it the volume and open interest information in that current month. If you want to be looking for deeper information, here is the bulletin. Okay, I'm going to go ahead and put this in the chat so everybody can see. Everyone. And you can start looking at this and using this as a tool to be able to more accurately assume the context of the marketplace. And that's really what we're all about, is what is the context of the marketplace? How can we act in that context in our best interest? So this is the CME bulletin. They used to hand it out on the trading floor in real paper. But if you were to look at, let's say, crude oil, okay, you see how this says preliminary? This has been updated to final, but the only thing that's likely to change is going to be the open interest. So I'm going to restart that page. Now we've got final. I'm going to make this real big so everybody can see it. Okay. So when we're looking at a product like crude oil, you've got March, you've got the settlement price, you've got the net change, you've got volume, you've got open interest. But if we're only looking at the open interest from the front month, we're missing a whole lot of information. Crude oil trades out a year in advance. We have some pretty decent open interest already in December of 24. So the total number down here is what I'm collecting, because it's telling me the picture of the whole contract, all of the contract months. I also collect the total volume, because there's pretty decent volume all the way out for a couple of years. All of that is important in that information. Okay, if we were to look at, say, the equities, here's the settlement price. This is the preliminary Wednesday's information. Restart the page. Now we're final. Always make sure you're on the right date and final before collecting this information. Total volume, total open interest, net change. Is it as important in the equities, which really trades the front month primarily, to collect all the information? Well, I mean, we've got, 56,000 in open interest in the June contract, which we will be, which won't even be the front month until the second week in June. In March. Boy, I can't wait for the second week in March. It's freezing here. Anyways, so I'm collecting all of the open interest and volume, total number traded, total number of open interest. Then how do I store that information? Okay, this is brand new for this year. Take a screenshot. It's the date, contract month, volume. If it's greater, it's green. If it's less, it's red. Open interest, the total, missed a day here. That happens from time to time. But look at what's been happening with crude oil. We've got a pretty big increase in open interest, even while we've been somewhat range bound. Something's about to change. Closing price, change of the closing price, regular trading hour delta, and then overall direction, attempted direction. Okay, I use value basically. If value is lower, direction is lower. If value is higher, direction is higher. So when I see this, I'm going to start paying attention. There's some energy coming into this marketplace. And when it becomes directional, you'll probably see delta opposite direction. When you see that delta divergence, it's another divergence that can help you to recognize an opportunity. The longer time frame traders don't always win, but most of the time they're going to end up getting us, the short time frame traders, in the wrong direction, and then we're all going to run it up on each other, helping them get paid. It's almost unfair, but that's the way it is. So if we are aware, if we're watching volume, open interest, and paying attention to delta, we can put ourselves in a better position over time. As day traders, as swing traders, always be thinking about what direction is the market attempting to go and how good of a job is it doing getting there. And the use of volume, open interest, and delta in congruency with each other can be really helpful. Like I said, this is a study that takes time to understand and time to develop a sense about, like everything in trading. And sometimes, it can be 4 months of collecting this information, waiting for it to tell me something. But when it tells me something, I know I have to pay attention because changes occur quickly. And if I'm not paying attention to that, I'm going to probably miss some of the change and a lot of the ability to take advantage of it, to use this information to my advantage. Now, I'm sure there's some questions, and I'm more than happy to spend some time answering them.
There sure are, Hogue. And also, full disclosure, I've been working on some things in the background that need to get done in an unfortunately timely fashion. So I haven't been totally on top of them, but I do have the questions I've marked for that. So JD, you might need to help me, but Some of the ones I marked to answer live. Here's a good thought question. Daniel asks, does our activities as traders really have effects on the market price movements?
To one degree or another, your one lot does matter to the market, even if it's just the fact that you're assuming the risk that somebody else may need to get out of. Overall, if we're a one lot trader, are we affecting price movement at all? Probably not. As a community, sometimes we do. Take a look at an overnight inventory adjustment. Price moves away from settlement. The market opens regular trading hours. All of those shorter time frame traders holding those positions, if they don't continue to get paid, they push price back to settlement. It happens a lot. If you have questions about that, there's group coaching, and there's the market forecast. We talk about inventory adjustment in the morning quite often. So as a one lot trader, we're not moving the market much, but as a community, in small ways, it does offer us the opportunity to take advantage of basically our community, the shorter time frame traders. I like to call them direct competitors, because they're in our time frame. Are they competing with us or for us? Maybe to some degree they are, but our time frame, our traders, the overnight traders, when there's no volume, there's really no longer time frame traders executing during periods where there's no volume. They're not there. So we can make that assumption in the overnight, when price moves significantly away from settlement. If there's no continuation, there is a probability that price will return back towards settlement. But as a group, we can move the market in small ways. As an individual, no.
And this plays into what I mentioned yesterday about the difference between sim and trading the live markets. Is we did that sort of thought experiment where you could have a whole bunch of people scalping in sim, and suddenly you're up to a sizable percent of the NQ volume. Know that in real life, somebody always has to be willing to take the other side of that trade. And if you're trading a huge amount of volume, especially if you're doing that in sim, stop and think about, you're not going to distort the market in real life, or at least not benefit from it. So think about that when you're trading sim versus a live account. I see two questions here that I think kind of go together. I think they're just more technical about it. So I'll just read them both. So volume and open interest always move together. Is there any condition where one rises while the other falls? And then let me just read the second one, because I think it's similar. Is it possible for open interest and volume to go opposite directions with each other? Are you open interest rising and volume following? If so, how would you interpret this? I think they're kind of getting at the relationship with both these questions.
Yes, it is possible for volume to increase while open interest decreases. You think about, okay, volume and open interest increasing in an upward direction. That's money coming into the market. If volume increases but open interest decreases, that's money coming out of the marketplace. Volume and open interest are not that tightly interwoven, but you can have volume increase as, let's say, you've got a big move to the upside over a period of days or weeks. Volume has been increasing, open interest has been increasing. You hit a down day, the volume may still continue to increase, but that down day, losing open interest may tell us, aha, some of our longs that have been carrying this thing all the way up here probably liquidated some of them. There's some profit taking there. That is perfectly normal for that to happen. One or the other might give way to the indication that the auction may be tiring in that direction. Doesn't necessarily have to be both to further complicate things.
Nice. Eddie, here's a question that I think you might be able to help with, because it's more, I don't know what our standing is with the free practice accounts and things like that. So someone asked, do you need to reset your account even during a trial period before so there's a couple context parts of this question we might have to dissect. Do you need to reset your account even during the trial period before getting it funded? Reset as exceeding your daily loss limit on practice trades. And how do you reset your account? So what I think that they're asking, what is the state? We don't do the free trial at the moment, Eddie? Do you want to elaborate on that?
Okay, well, the thing is, what you're going to get a practice account. You're going to get your combine. You have the ability to reset that practice, but if you do need to reset the trading combine, that is something different.
Yes. Maybe if there's some clarification of that question, I'm a little unsure. But on your practice account, you can just reset it whenever. How you reset,
Correct.
I think there's just a button to reset it. But be
Right,
careful that
correct.
you are, in fact, in your practice account, right?
It will initiate the price for it. So you'll see that. But yeah, in the practice account, you can reset that as you like.
Cool.
But in some, if you have let's say a trade of 8 trial, you can't reset that. We can't reset that for you. That's something that the platform is providing for you, not Topstep. So there's, the practice account that comes with your trading combine. If there's a trial account that you've taken from another source like Trade of 8 or Ninja Trader or any of those we're not going to be able to adjust for you.
Once again,
Right.
as far as these program specific questions, Eddie has done a lot of talking with people that are interested in the program. Do you still take appointments for that, Eddie?
Yes, it's under the calendar. What we can do is I can share the link. Basically, it's a half-hour booking where you, the trader, can come with any question that you do have regarding the program, regarding trader approach. I've talked to, my time here, 11 years, talked to thousands of traders, and I do get a good idea of what traders need to do, and I try to share this with every trader I talk to. What's the best approach? What's my mindset, and so forth.
So Eddie, why don't you drop that Calendly link in the comments? And if anyone has specific questions about the program, just arrange something with Eddie would probably be easiest. Hogue, how about this? Is it useful to look at or use volume profiles over a longer period of time, like a week or month, to see what the long-term point of control and value are or is?
There is a lot of use in that. You generally don't keep those composite profiles handy. That's one of the things I like about Trade of 8 is I can create one in volume profile very quickly just by putting the volume profile and expanding the time for it. But yeah, especially in range bound periods of time, you're going to see, the bell curve being really kind of even. You're going to get very specific value high, value low. And that's, something I will look at during range bound periods of time, because, I think that the information, there we are. I think that the information in it is useful, particularly in range bound trade. Again, because, we know over time where value high is in that longer period of time and value low is in that longer period of time. And of course, point of control, which I'm probably not going to be trading.
Cool. Just an interesting thought here for Anonymous. Just a comment you met. I have an answer for this, I think. You mentioned in a previous lesson to keep it simple, stupid. To me, this doesn't seem like keeping it simple, to be honest. Yeah, we're kind of damned if we do, damned if we don't. Where people were saying some things are too complicated. But I think the idea of Delta, when you boil it down to its simplest, it is a simple idea. You're really just gauging how aggressive people are, right, in one direction or the other. So like if you use it like that, I think it's a pretty fundamentally easy indicator to understand. I think when we talk about getting complicated on things like indicators, there's a million indicators out there, and when you start using crazy exponential smoothed Fibonacci gobbledygooks like Dr. Seuss machines that I can't even understand what it is you're trying to show here, that's more of what we're talking about when things get a little bit too complicated, right? I think
Right.
that people tend to overcomplicate things, but I think that Delta is probably something that belongs in your toolbox.
And, it seems probably, vague now or difficult to kind of keep in a simple way, but I think, just driving a car was at one point very complicated because we had to think of every little thing the first time we drove a car. Where's the gas pedal? Where's the brake pedal? Which way do I turn? What do I do with the turn signal thing if I want to go left? Which way do I turn? With all of those things are things we have to think about consciously as we drive a car longer. You could probably drive a car to California right now without ever thinking about the what is it, secondary functions we create now. As you get into collecting the information, volume, open interest, and delta, a lot of it's not going to make sense. But I suggest you continue looking at it and continue thinking about it and making it part of your ability to recognize the context of the marketplace, because you do it long enough and all of a sudden something is going to appear to you and you're going to say, you know what, this is a big deal. There's a lot of open interest in, there's something that's going to change here. This is probably going to be a bigger move, and you're going to see that move and you're going to say, Hogue was right. These are great. Now, it may be 4 times a year when you're going to find something that's that important in the volume, open interest, and delta combined, but it's going to be powerful when you do.
Yeah. Yeah. One last thing about it. I think that the best ideas come from just eliminating a lot of extraneous noise, right? Go on wherever board you use for trading and go look up the due diligence that some people put out there, and you're bound to find tons of posts that have due diligence it looks like, if you've seen the movie Seven, it's like the notebooks the serial killer keeps. It's like 50 pages of different things that have happened, and that's usually too much. All right, you're not gonna be able to do that consistently.
See somebody who's asking to find delta data. If you're on TS Trader, it's an indicator, volume based cumulative delta. Click that. I like to thicken up the lines so that they're more obvious for my old eyes. So you're going to see that the delta today has been increasingly negative, but it's congruent with direction. We're not finding longer time frame buyers or sellers in this.
A few more. Looks like JD's answering one of these questions in the comments here. Someone asked, what's a good number for both volume and open interest? I guess it depends on the product.
Yeah, different products are going to have different, the volume in the S&Ps is about just over 2 million to a quarter to almost 2.5 million contracts. Crude oil volumes around 2 million contracts. Open interest in the crude oil, open interest is around 2 million contracts. But you're going to see, depending on the amount of participants, sometimes when it's slow, you're going to see 600,000 in volume in crude oil. Yesterday, we had 1,109,000. That's day before yesterday. I haven't put up my numbers in this spreadsheet just yet, but there's no finite number is going to be good or bad. It's the changes that make a difference.
Nice. Stephen asked a question that kind of goes in the order flow here, which we could probably do a several month course on in general, but it says, have you ever found that monitoring large orders in the ES adds value to evaluating who's in the market? Today I have some trades in the high 200s for trades hitting bad bid and offer largest of the day. Yesterday I see one trade of 750 in the ES. Can it help?
Yes, order flow can certainly help. And what we're looking for in delta divergence is in essence order flow. When there's a lot of selling in the market, but the market isn't going in that direction, that's absorption. And even, some of your best order flow tools will point that out, because the way the longer time frame operates is, if they have 8,000 e-minis to buy one day, they don't put a bid in for 8,000. They feed them in at random numbers. So you're never gonna see the total number that they have out there. They call them iceberg orders.
Yeah.
So those iceberg orders are gonna come in and they're gonna replenish as they're executed, until the short time frame or whoever's selling into it gets the wind of, hey, this market isn't moving lower, I'd better get out, move the price higher, and then they'll move those bids higher if they still have more business to do.
Yeah, that used to be why, not probably as much now. I think things have gotten more sophisticated but why VWAP was something that people monitor so closely. Still worth taking a look at. But the idea was that at these large institutions, their traders were graded or rewarded appropriately based on how they executed these large orders versus what the volume weighted average price was for the day. So if you were selling, by definition for the day, if you had to sell 8,000 e-minis and you sold them above the volume weighted price average price, you had edge there. You did it. So the idea is, if that goes above, if it's rising, that you'll see selling pressure. If it's going down, you'll see buying pressure from people who got to get rid of these big orders. But yeah, you'll see turbo icebergs. We saw it all the time in the treasury, where there would be, the purest iceberg, just a one lot that doesn't go away. It'll just absorb anything that goes at it. It just sits there and everything gets thrown into it.
One lot just bought 1,000.
Yeah. I'd be curious, when you see a big lot go through just all at once, there's other reasons besides. This is why order flow, I said before, got a little bit of trouble, is like the holy grail, because this is where like the tea leaves are really read. If someone puts through an 800 lot order of ES, for instance, there's a reason, and it may not be just because they want to put through an 800 lot to get it done. For instance, they might be working spreads in something else, and they know, this is where like the algo trading goes in, is if they're on the bid in a correlated market below it, they might be trying to slam through an 800 lot, knowing there's a bunch of other spreaders that are again going to push that market down into their bid. So there's all sorts of strategy that goes on as far as order flow, which we'll touch on a little bit in this course, but it does get a little bit complicated. And that's a lot of what algo trading is order flow stuff. Do we have an order flow session? I know we cover it. We could probably, I think, through this class and afterwards, we're going to ask you guys what are topics if we were to do a future boot camp or something, like for a week or a couple classes. What are the topics that you're most interested in? And I think order flow is definitely up there. Is Delta best on a daily and 30-minute chart, not on short time frames like 5 minutes?
Well, it's not necessarily chained to any particular time frame. I look at a 30-minute chart, but if I'm suspecting other time frame or longer time frame participation, it really doesn't matter if it's a 30-minute chart or a daily chart. If you're monitoring overall day time frame delta, doesn't matter which chart you're using, it's the same.
Yeah. Sometime in the future, are we going to talk about the island top and bottoms and how they work?
Yeah, that's certainly something that we may have been able to touch on technical analysis, but we are going to be, continuing to expand these, I think, and certainly welcome to ask about island tops, island bottoms on forecast or group coaching until we get to that class.
Great. Well, I'm going to ask, is scalping frowned upon in your platform? No. No, if it's scalping that would theoretically work in a real market. Like, there's nothing wrong with, like, we don't inherently frown upon short duration traders or people that are trying to take a little out of each trade. That's a perfectly valid way to trade if your win rate and your average win loss works out to be profitable. That's fine. It's just that what we're kind of increasingly inundated with is because we have people passing things on sim, is people who are just going, pardon my French, balls to the wall, power, just making trades that are just a false part of the simulator system. So like that, and you'll know if you're doing that. Like, I don't know what percent of our traders have never traded in a brokerage account, but many of them had, and you'll kind of feel that something's off if you had something you were trying to do in a brokerage account and it always loses you money, and then suddenly you're making a lot of money in a simulator. That's something to look into. And Jack, can you translate the difference between open interest and volume for us? John, I want to make sure I say this very carefully.
Go ahead.
So, well, no, I was going to let you give your definition. This is your presentation.
Oh, okay.
Volume is just the total number of contracts traded in the time period.
Mhm.
And then, oh man, I hope I don't get this completely wrong here. Open interest is the number that exists. Okay.
Yeah. Yep. So yeah, volume is the total number of contracts that change hands in a session. Open interest is the total number of outstanding contracts, and volume can increase or decrease open interest.
So think about it like if a million people came in to buy and a million people came in to sell in one day, there'd be a bunch of open interest, 1 million to be precise. If nobody showed up the next day to trade and the contract was still active, there would be no volume that day, but there'd still be open interest. So that's the difference. Open interest is how many are outstanding. And you'll see that drop because you're trading futures, and really nobody is really holding the futures to their expiration date, right? Not a lot of people are taking or giving crude oil, for instance. You'll see that open interest drop on contracts as they get closer to expiration.
It's what makes watching volume and open interest difficult during rollover, because you've got one contract that's losing volume and open interest while the next contract is gaining open interest and volume. So whenever like crude oil is in crude oil week, in rollover week, which is every month, I'm warning people, hey, be careful, because volume and open interest is kind of blurry during that period of time. In the equities, thank goodness it's, a week or two every 3 months. And the rest of the time we get very clear volume and open interest information. But again, when it's rollover, all of those positions and all of that open interest is either some of it's going to expire and be paid in cash. Some of it's going to move into future months, and the ability to read open interest and volume during that period of time, again, because one's going down, one's coming up. We don't really know how great volume is. And one of the other issues is a lot of our longer time frame traders are more interested in getting a cheap rollover than becoming directional. I mean, if you think about it, a tick in the E-minis is 1250. If you have 10,000 contracts to roll, if you do it on the bid or the offer, whichever one's to your benefit, it's going to save you a lot of money.
Yeah. Quick question, then Eddie, I'll let you add to the scalping thing really quick. So people are asking where you find open interest, and does it calculate daily?
It does calculate daily. I did put the link into the chat. This is where I find that information. It's on the CME group website. Here it is. Oops. Wrong website. Here it is, CME Bulletin. I'll put it in the chat again, and I'll put it up on the screen here so you can see. Here it is in the chat again. That's the CME Daily Market Bulletin. and all of this is updated every day. Again, volume is relatively easy to calculate. The difficult part is open interest. We've got
Yeah.
the final here Wednesday. That's yesterday. Here's the open interest information, total open interest information there.
And this is not data you can get intraday.
Open interest, you cannot. It takes the exchange till 9:30 the following day to come up with the actual number.
Yeah, because this is
They-
calculated by the CME, right? So I guess they're in control of when and how this is disseminated.
Mhm.
All right, Eddie, additional note about the scalping there?
Yeah, well, the thing is, I mean, I talked to a lot of traders that ask about that. I mean, I myself scalp at times, and you've got to remember too that you know, in the trading combine, it's simulated data from live. Okay, so it's going to be a little different. That's why, you know, we do see a lot of people scalping and saying, "Hey, this is easy." Okay, but the thing is, I mean, the big picture is if and when you did get funded and you tried that same method, it would be a failure, and it would, you know, it would blow the confidence, and you'd be asking yourself, scratching your head, going, you know, why isn't this working now? So, you know, take that into consideration when you are scalping. But you know, it's available. You can do it, but just be careful with it.
Well put. So Hogue, JD, could you throw the Discord link in the comments? And then Hogue, you can take us home. Thanks, everybody. Great class today. Great third week. We got one left. I'm gonna get a new light. It's gonna be epic.
All right. Thanks, everybody. Jack, John, Eddie, and thanks to all of you. As always, it's our goal to see you succeed. Thursday, tomorrow's the last day of the week. Make sure that you protect profits, make a little bit of money tomorrow, and I authorize you to take the day off early. See you tomorrow morning for the market forecast. We have the podcast coming at everybody today at 3:00 with Dan and Jack. And then again, you'll see me tomorrow morning on the forecast. So have a good night. Enjoy the podcast. Trade well. And we'll see you next Monday for week 4 is indicators and tools, introduction to the profiles, business planning, and a trading plan. We're going to take a look at some of the things we look at. In other words, have a great night, and we'll see you tomorrow.
See you Monday, not tomorrow.
Thanks,
I'll see
everyone.
you tomorrow.
Have a great weekend.
Bye.